Welcome, friends, to Unit 3 of Personal Finance, BUSI 1307. This is Randy Saleh, Assistant Professor of Business, guiding you on our personal finance journey. And here we are, Unit 3, Investments. Hope you find this unit very practical and very helpful because it's so important in our financial plan. We're going to look at just some fundamentals of investing. We're not going to try to make this too complicated. Again, this is advice for you. If you are already a serious investor, then these are just tips and rudimentary things you probably already know. Most of us are not too familiar with investing, and it can be very complicated. It can be very intimidating. So we're going to try to keep it as simple as possible. Some of the terms that we should know. And again, you're going to be investing, my friends, throughout your life. Many of you, when you go to work, you're going to be given an option of a 401k or a 403b, depending if you work for private or nonprofit organizations or government organizations. And you get to choose your investments for your retirement. You're going to open up an IRA. So we need to learn a few things here to help us out. So let's get started. The key to wisdom. Admitting one's own ignorance is the first step in acquiring knowledge, so says the philosopher Socrates. Understand what you do not already know. That is very important. The key as we go into this unit in investing is once you find something that you want to invest in, you need to know as much as you possibly can about that. So you're going to have to do some due diligence and research. And this is good for anything, my friends. This is just general philosophy, the key to life. Understand what you don't know. So what we're going to try to do is keep this simple. When we start investing, we need to think in terms of a minimum of 5 years. We don't go out and say, you know what, I think I want to buy a car in 6 months. Let me start investing. That's not what we want to do. I mean, if you want to buy a car in 6 months, then you just need to start, stockpiling as much cash in a bank account as you possibly can. But that's not an investment. Investment means I don't need this money for at least 5 years. And so I can put it into something that I'm not going to worry about for 5 years. And we also need to look at interest rates or our rate of return. And the minimum we need to look at is 6%. That's just the bare minimum, okay? Because taxes and inflation can really eat up any type of investments. So keep it simple, 5 years out in the future, and at least 6%. Then we can consider that as an investment. Before we start, how is our financial base coming together? We're going to go over some stuff, and that's going to look very appealing to us. But always, this is this is the third unit here. Do we have our cash flow plan established? We've got to have that. How is that emergency fund looking, my friends? Do we have 3 to 6 months of living expenses? That's what we want to have before we start this investment stage. Are we managing our debts? Are the debts coming down? Are we utilizing that debt snowball? Do we have most everything under control and almost paid off? Here's why we say that. If you jump into investing because something looks great, or you have a friend that gives you a tip and says you need to buy this stock or you need to get into this right here, without a cash flow plan, without an emergency fund, without those living expenses, or lots of debt, when an emergency happens, and I'll say this again and again and again, what do? We start robbing our investments. We stop investing, and then we take money out, and that has a lot of tax consequences to cover our emergencies, and we get in a vicious cycle of never having the investments we want. So all of our plan must be coming together before we hit this stage. Just want to make that clear. It will really help. So we need to have goals. We've gone over goals in this course already. So in investing goals, how much Do we want to invest? What money do we think for our investment goals? Is it a set amount? Is it I want to put out $100 per month, $50 per month, $1,000 a month? Put that goal out there. How long will it take you to obtain that type of money before you can start investing? Okay. Now there's some great tips out there that we can literally use small amounts to get this rolling. So, how much risk are we willing to assume in an investment program? This is where the risk-reward theory comes into pure focus, because in finance, it is a direct parallel. The more risk I take in an investment, I should get a much better payoff than just setting it in a bank account. So how much risk are we willing to assume? And a lot of that has to do with our age. Okay, my mother's account, and she's 80, in her upper 80s, almost 90. We're not risking anything. We are just preserving her money. Okay, if you are in your 20s, then you have the time and ability to put some very high risk things together and let that grow. So, got to figure that out. What's the economical, personal conditions that could alter our investment goals? Okay, a lot of that is job security. And again, are you willing to make the sacrifices on anything you do in life, but especially in investing? If I say I'm going to invest $200 a month, then probably something else. I'm not going out and buying the stuff that I like to have. I'm going to sacrifice, some of my playthings. Okay, maybe the car that I really don't need. I need the car, but I don't need that brand new car. What sacrifices are we going to make? And the sacrifices you make early in life pay off so big, my friends, because, man, you can snap your fingers just like that, and 5 years of your life has gone by. Another snap, it's 10 years. You could be quickly into your 30s and 40s and 50s before you know it. And if you made some of these goals early in life, they're going to pay off very well for you. So, getting the money needed to start that investment program. All right. How badly do you want to achieve these goals? All right. Are you willing to sacrifice, there we go, those purchases? Okay. Are we going to take advantage of employer-sponsored retirement programs? Can we do that? If you are not taking, and we'll get to this as we finish our financial plan too, but if we're not taking advantage of what our employer is doing in a 401k or any type of retirement, we need to, because we could be throwing away money philosophically if we're not getting the full match of what our employer will do. So, again, maybe there's extra elective saving programs, automatic deductions. Remember how we build habits. If we can make this automatic, it makes our investing so much easier. Okay. Sometimes we can make it an effort, maybe 1 or 2 months a year, to say, you know what, this month I am not going to spend anything. And possibly in the situation that we are in now with this global pandemic that was going to last, unfortunately, much longer than anyone thought, maybe we're not spending as much as we used to on some of the consumables. So that may have given us some effort or some traction to put more into savings and investing or paying off debt. So, man, can we do 1 or 2 months of just, I'm going to put all of my extra money into investments versus into just stuff that's going to depreciate and erode away? How does time value? I think we've gone over that in our first unit, my friends. Some people think that, I can't really start right now. I only have a little bit of money left over at the end of the month, so I'm going to wait. And this is probably the worst, the biggest mistake that people make. I'm going to show you something I've just learned this year of a program that literally invests your spare change from your debit card, okay, from your bank account, and it's called rounding up, and puts that into an investment account. And all of a sudden, you can do that. There's some great internet applications that are legitimate finance companies that are helping students, because they give you a free account, and other people as well, that are working people to start saving even $5 a week. And if you can do that, it can really build up, okay, because they do grow over long periods of time. All right. And absolutely, the time value, again, if we are in our 20s and 30s and 40s or 50s for that matter, I mean, we're all going to be working for a very long time. We're not retiring at 60. If you did and you could, congratulations. Most of us are going to work into our mid 70s to 80s. We're going to have to. And so a good rate of return, then that's going to be with risk. We'll get a better rate of return, and it can have a lot to do with our overall investments. There's the risk and reward. There's that cat. Now, that cat could go find a little bug. That cat could find a little mouse, but that cat's going after a pelican. The cat might get eaten. There's the risk and reward. The higher risk, you must have a greater reward. Okay. Now here's the risk that we have in our investments. There's investment risk. The chance that an investment could lose everything. You could go completely broke. Okay. That is out there. Now, how do we reduce risk in life? Well, we do what Socrates says. We admit that we know nothing about anything, and we start building our knowledge base. So you conduct a lot of research. You look at experts in the field. You can ask parents. You can ask relatives. Again, you can go to seminars. But there's so much free research out there on the internet right now. We conduct a lot of research, and then again, we make our best decision. Nothing will ever be risk-free. That's just not the way life works, and we know that. So, wait a second. What if I just put my cash under the bed? Okay, is that risk? Well, there's no investment risk. Okay, because you're hoarding your cash and you've got it under your bed, and maybe you got $10,000-$20,000. But is there something called non-investment risk? Yeah, that's inflation. And inflation has really been eating away at the typical American family since the literally early 1990s, because the government has basically tampered with the formula of how we calculate inflation. And the government has said it's only 2 or 3% a year, and those of us working know it's a lot more than that. And I've seen the research; it's more like 8 to 12% a year. So that is over 10 years. That could be 120%. So that money, that $20,000 under the bed, has lost its purchasing power. Yeah, it's safe from investment, but no risk, no reward. So we got to find the balance here, my friends. Got to find the balance. I always think it's good that you have some cash under that bed, or you have it in a little safe or somewhere where you can get to not all of our cash, but again, maybe a couple $1,000, just so if you have an emergency, you can pay cash pretty quickly versus if something goes wrong, if electric goes down. Again, banks can't have their wires crossed, and they had that in Hurricane Katrina in Louisiana when Hibernia Bank in Louisiana, one of their largest banks, basically lost all of their power for about 2 weeks. I mean, their debit cards did not work. Hey, that may have changed now, but it's always nice to have some cash, but not all of it. Now, as we look in investments, here's some few rules. The more liquid your assets are, okay, and liquidity is nice. Liquidity means how fast can I get that in cash? Well, that cash that I said you have in your home, okay, in your cookie jar, it's already cash, and so you get to spend it right now. Does it gain any interest? Does it gain any momentum? No, not if it's in your house. Okay, the more liquid an investment, generally speaking, the less return you're going to get. So yes, there's always associated risks of having something that's just too liquid. You just don't get anything from it. Again, we need some of it, but that's not where we're going to put all of our cash, certainly in our working years. I did say as you get older, you probably want to be more liquid. But I mean older. I mean in your 70s and 80s that you may need nursing expenses, etc., etc. But right now, we want to get the most return we possibly can in our investments. Interest rate risk, okay. Other risks out there. We're going to look at corporate bonds. We're going to look at bank accounts, fixed rates of return. If the interest rates go up, And for some reason they have not, but if they did, if you're in a 3% certificate of deposit, excuse me, or a corporate bond paying 4%, and all of a sudden interest rates rise to 5%, well then you've got a risk there. You're losing money in that investment because you can get more in another investment. Okay, so that's something to look at. Really hasn't played a big role in the last 20 years. This is big. A business failure. Probably, your airlines right now that had a lot of problems due to the global pandemic. And business failure basically means bad management, unsuccessful products, competition. If we had a boatload of Kmart and Sears stock, now of course Sears bought Kmart years ago, or Kodak, we'd probably be in bad trouble. And those were companies that people flocked to in the 1960s, 70s, 80s, maybe even early 90s, because those were very safe investments. Those were some of the largest organizations in the world that were paying good stock dividends, and they're completely gone. So the economy may become business to be less profitable that we're in right now. Stocks, bonds, again, this is business failure. This because the management of the organization, the direction it's heading is very poor, and nobody, it's not creating value for anyone. That's a huge risk. Of course, market risk. We are in this, when we get into the stock market, there's always going to be fluctuations, okay? Systematic, unsystematic behaviors of investors, that's just a risk that we have to assume is going to happen. Well, there's what we're living in right now. Yeah. We must be evaluated our domestic investments. How do we start protecting ourselves? I mean, I've already scared you, right? So, well, shoot, I'm not going to invest in anything. No. I want to be aware of what's out there. The way we combat risk is to diversify our investments, okay? It is very unlikely that if we had a diversified portfolio of stocks, bonds, real estate, gold, silver, things like that, if everything went down to zero, well, then we'd be in Armageddon, okay? The world would have blown up. It's just not going to happen to where everything is worth nothing, okay? Now, I may have one stock. I may have put everything into Kodak. I may have put everything into Sears because I thought it was great. Well, now I had a huge risk because I had no diversification whatsoever. When the company went down, it took everything, and I kept waiting for it to come back. Another big problem with investing. We love some of the investments we will do, and we think that company will just be great to us all the time. That's why we take the business courses. We understand the environment and understand when a company is just going south. So diversification will help that very much. We have seen the stock market hit hit to about 17.5 in April, but it bounced right back. It's back at an all-time high, close to 30,000 points, somewhere between 27 and 30,000. So it's gained everything back. So couple of tips as we move on. When the markets do this, and you're riding high, and all of a sudden it goes like that, do not panic. Don't panic. All right, it will come back up. It may take a few years, but that's why we need 5 years. We're in this for the long haul. Just a couple of little pearls of wisdom that I could give, and I've been affected by it. I've done the wrong things, and so we can learn from each other's mistakes. We set our investment structure up, the things we understand that we want to invest in, and we leave it in there until we just absolutely need it, and that's going to be for most of us in some sort of retirement stage. So, again, the safest investments are investment incomes, depending on what stage of life you're in. And again, you may be given some of this information, and I hope you're enjoying the videos. I actually hope you're watching the videos, because I hope there's some good information here for you. I've been looking at the YouTube channel here that I have, and some of the traction's not there that I thought would be there as I make these videos. But I hope you're watching. The safe, and you may give this to your parents. Your parents may be older, and as soon as you're looking to go into retirement, we change. Okay, they probably want predicted sources of income, very predictable. which are like savings accounts, securities, and certificates of deposit. If you're in your, again, just coming out of college in your 20s and 30s, even 40s, this is really what you probably do not want. You need to get into something that's going to give you much higher rates of return, because we're looking at like 3% right in here. Again, this is preservation. This is not accumulation. So, bank accounts. It's crazy, my friends. Growing up in the 1980s, you could literally get 8 to 9% in a savings account or a money market account. Okay, so let's do 9%. And let's do the rule of 72. 72 divided by 9 is 8. In 8 years, your money doubles. So you put $10,000 in a bank account, and those 8 years, you got 20,000. Okay, 16 years, you got 40,000. That's how great it was. That's what built this country, built the American middle class, because you could literally, bank accounts were good investments. This is what they've been. 1 to 2%. It would take, it just doesn't double. It's good for parking your emergency fund. It's good for having some liquidity, and when things go bad, definitely. But we cannot count these as investments anymore. Sorry, I wish we could, but we can't. So, but you get your money very quickly. And there you go. Some of these may have a 1% boost. If you have, again, if you put a $100,000 money market together, a $100,000 CD, you're going to get a little more interest, but certainly not what I was talking about in those great 1980s. Good places for your emergency fund. So investment income is part of your strategy, and it becomes different the closer you get to where you're going to be relying on all those investments, for your income for the remainder of your great years on this earth. So, what can we do to get some higher income investments? Well, we can go, instead of a bank account, we could go into corporate bonds. Okay, we could look at preferred stocks, and we're going to look at all of these, my friends. We look at mutual funds. We could look at rental properties, real estate. Okay, now, are any of these going to be higher risk than putting your money in a bank account or under your bed? Absolutely, they are. But again, the reward is a greater rate of return. Some of the topics that we look at in this third unit is our asset allocation. Again, this is the process of diversification. So we have stocks, we have bonds, we have real estate, we have cash. We're lessening the risk that everything could go broke at one time. Also called hedging our bets as well. And so that's what we want to look at. And that's what I'm going to hopefully show you how to do that. Time. We're all beautiful right in here. And if we're in this kind of age group, and we've got time to really start it now, okay? Little things that we can do. If we're a little more mature, all right, we still have time, okay? Because we're going to be working. But if the advice that I would have liked to have given, again, I wish my father would have given me a little more of this. Now, I was born late in life, and he was a product of the Great Depression, World War II. Very conservative, and hey, again, he always had bank accounts that paid 8, 9%. So he said, son, just put your money in a bank account, you'll be fine. Well, we can't do that anymore. Start your investment if it is possible. The earlier you are, we have that time value of money. All right, let's look at it. Here's what's looked at as the investment pyramid. So the broader bases are less risk, like financial security, so your cash, your money market, your government bonds. Good financial security, just not paying anything out to you. A little more safety, maybe some income stocks, and income stocks are typically what we call preferred stock. Municipal bonds, again, it's another level. But when we, want to get up to this level, right in here, we're going to have to go outside the traditional banking, traditional bonds. We're going to have to get into mutual funds, electronic traded funds, real estate rental property, stocks, and speculation that, hey, who's going to be the next Elon Musk in this area? Who's going to take something and really blow it up? And if I can get in early, these are some of the things that we'd like to look at. Higher risk, higher reward, great for your grandparents right in here. Like my mother, she needs to be as secure as possible. Okay. Different sort of investments that we'll also look at. What about rare coins? What about art? You know, gold and silver, stamp collections. Yeah, those are alternatives. Again, you need to be very wise in that area. You need to have a lot of knowledge and information. But we're going to hit that. And we're going to see, do those really pay off or not? So, as we look at our plans, all right, and again, I certainly encourage you to read the book, and that's why I tried to get you to buy this book. I think this is a book that you don't really want to sell back, the Kapoor Personal Finance, because it stays with you, and it's got just such great advice here. Again, we're establishing our goals, all right? We're determining with the type of money that we're going to have. Well, even if it's $100 a month, and there we are. We're starting off. That's very good. Specify what's available, the type of investments we want to evaluate, research the risk. All right. Again, we probably can't do everything. So what's the one investment I could hit, and then some alternatives, and then we just continue to evaluate our investment program. It's not rocket science. Okay. We're not going to make it too hard. And we want to be very effective in our planning. First things first, again, as I reiterate, don't skimp out on your emergency fund, my friends. Get that $1,000 to $2,000 to $3,000 ready to go right now. Okay. If emergency happens, you can pay for it. I've been a victim of this. I'm always going to be honest with you. I've seen too many, and unfortunately, with the environment we're in right now, of this global pandemic, I know, and I've read and I've seen the research that there's so many families, hey, I'm not shading anybody. You got to do what you got to do to survive. That's what we're doing. But they went into their 401ks and they basically cashed out a lot of money just to stay alive right now. And you can do that. Yes, you can. But it comes at a cost, and it comes at a 10% IRS penalty along with your taxes of ordinary income that you're going to have to pay. So it could be to some people to get their funds out, maybe near 40 or 50% taxes just to get it. So that emergency fund is so important, isn't it? Absolutely. Here's what we look at in our investment: stocks, bonds, real estate, alternatives, and mutual funds and exchange traded funds. So we get a better understanding of our investment strategy. I hope you're excited, as I am, about this unit. It will be a learning process for us all. And when we're finished, I hope you have a better education of how you can start your investment priorities and investment goals. So after this, we're going to look at investing in stocks and bonds.